Yes. Good afternoon. Good afternoon, everybody. Good afternoon, ladies and gentlemen. On behalf of MCX and S&P Global Platts, I extend a hearty welcome to each one of you who has joined today at the webinar, where we are going to discuss opportunities in commodity index trading. We have a distinguished panel of speakers and panelists today who will take us through various aspects of commodity index trading. Before we start, I would like to make 2 points to all the attendees. First, we have 2 sessions today, a speaker session followed by a panel discussion. We shall take up questions from the audience twice, once at each of these sessions. That is, once after the speaker session is over and once after the panel discussion is over. Please use the chat box that you will find on the screen of yours, on the right hand side of your screen, to type out the questions that you would want to ask. And also, as far as possible, please mention who would you want the answer to be from. The second point I would like to make to all the attendees is that this webinar is an educational forum where the speakers shall not give any future outlook on prices or on future likely movement of indices. Speakers also have the discretion to not discuss any investment strategies. The views expressed by the speakers are their own and does not necessarily reflect the views of their respective organizations. So with this brief introduction, I now request Mr. P.S. Reddy, MD and CEO of MCX, to kindly deliver the welcome address.
Yeah. Good afternoon, ladies and gentlemen. It's a privilege for me to welcome you all for this webinar on commodity indices. And recently we launched a futures contract, and that is very topical for us to organize this this program. And we are grateful to S&P for joining us and deputing their senior executive to address all the concerns that market participants have and the strategies that they can make in this particular, using this product. At the same time, I'm also grateful to Mr. Som Sundaram and Mr. Dilip and Mr. Anil for coming forward to share their understanding of the bullion indices, which we have recently launched futures contract on bullion indices. It's very important for us that this contract grow bigger and bigger, and this should be the flagship contract. Essentially, the index futures should be the flagship contracts of the exchange, and all other contracts will be complementary to the main index contracts. Of course, options is another area which we are aggressively pursuing to make it a successful contract. And this particular topic, as I said, it's very topical because recently we launched this contract, and this is this is being widely used elsewhere in the world, and the construction of this contract is also much to the needs of the Indian consumers or Indian market participants. So it's not that we have the products traded on different exchanges and made one basket for the market to trade. All the benefits are given on this very exchange. The products are traded on this exchange. The margin benefits, as and when the cross benefit margins come, it will be all the more useful for the market participants. We are also looking for a lot of education on the part of S&P to tell us how else a world over these particular indices are used for making this product a vibrant product. At this point in time, almost all 3,500 unique client codes have traded, and almost all 300 crores turnover ADTs it is clocking, and about 150 member brokers have taken active participation. We are grateful for all the participants for taking an active interest. Even the OI is also open interest has been increasing day by day, and that's a very good sign for us. But we are looking for more and more algo players to step in and give value addition to this contract. Obviously, the more the liquidity, the greater the attraction of the participants to this particular counter. So in the days to come, not even months, in the weeks and days and weeks to come, we're looking for greater participation in this contract. I hope all the participants will be benefited from the discussions and the kind of guidance that each of the speakers they are in their own right. External speakers are in their own right masters in these products and in these subjects. And of course, our own team members, Mr. Praveen, Shivanshu, and Rishi, I have been contributing substantially and engaging with market participants to make this product a vibrant product. With these few words, I thank Ms. Fiona once again, and Mr. Somasundaram, Mr. Dilip, Mr. Anil, and other my colleagues who are participating in this program. I wish you all success. Thank you so much.
Thank you, sir. I now request Mr. Rishi Nathani, Head Business Development MCX, to please take over. I request him to kindly introduce the speakers and moderate the first session. Mr. Rishi Nathani, please.
Thank you, Devo. Good afternoon, ladies and gentlemen. It's indeed a pleasure to be moderating this session on the opportunities in commodity index trading. I am Rishi Nathani, Head of Business Development and Marketing at MCX. I'll be moderating this session where we have very eminent speakers with us. We have my colleague Praveen DG, who's heading the index derivatives at MCX. We have Ms. Fiona Bol, who's head commodities and real assets at SP Dow Jones Indices. And we have Mr. Anil Ghilani, who's head passive investments and products, DSP Mutual Fund. First, I'd like to just talk a little bit about the indices at MCX. We launched all our indices under the brand MCX iComdex Indices on 20th December 2019, with representation from all the sectors which are traded on the exchange. Now, these sectors include the precious metals, the base metals, and the energy products. The MCX iComdex indices are excess return indices, and they are created from the futures contracts that are traded on MCX, where the weight of each constituent is based on the liquidity and the physical market size of these products. The liquidity is given a 75% weightage, and the physical market size is given a 25% weightage. At present, we have one composite index, 2 sectoral indices, and 4 single commodity indices. So the composite index it contains almost all the commodities that are traded on MCX. The 2 composite indices, one is the MCX Bulldex, which is the bullion index, which constitutes of the gold and silver futures contracts traded on MCX. And then we have the metal dex, which constitutes the 5 base metal contracts which are traded on MCX, which are nickel, lead, zinc, aluminum, and zinc. All these indices are governed in accordance to the principles of IOSCO for the financial benchmarks. And recently, on 24th August 2020, we launched our first tradable index futures, the Bulldex. So basically, this is a futures on the bullion composite index, which is the Bulldex, and we've got very good participation from the market. We've seen healthy participation and a total turnover of 2,120 crore rupees or 21.2 billion rupees in the contract so far. It is early days yet. We are seeing a lot of members, a lot of clients, hedgers, retail participants coming onto this contract and participating. There are a lot of proprietary trades also, as well as client trades. The benefits, the potential benefits of trading on these indices is that a person gets to access a diversified portfolio of commodities at one shot through the index. So they don't need to get into the individual commodities one by one. They can access the index, and through this, they can access all the commodities. For example, we all know that base metals are are used to predict economic recovery or downturn. So if someone is bullish on the economy, they can go long in the metal index rather than go long in each individual base metal and track all of those. Similarly, if they are bearish on the markets, they can go short on the index. Another advantage of these indices are they are cash settled. So there are no variable margins in terms of the delivery period margins, and there's no threat of delivery. So people who want to have a pure hedge, whether they're hedgers or retail traders or someone who wants to have an expiry play, can buy these contracts and stay on till the end of the contract, and they'll be settled in cash. There'll be no devolvement into any delivery. So people who want to take their investment decisions based on the expected movement of the index without having to worry about rollover or expiry of these contracts, this is a great contract to trade in. So I would encourage all of you to look into this contract, do your adequate research, and thereafter access these markets. Having said this, now I would like to invite my colleague, Mr. Praveen DG, who's head index derivatives at MCX, to share his thoughts with you. Over to you, Praveen.
Thank you, Rishi, and a great evening to all. Just let me show my slides. So I'll be taking a few minutes of your time just to give some brief introduction to our existing MCX iComDex index futures. So at present we have different variants of indices, like we have single commodity indices, sectorial indices, and we have the composite index, like the way it was earlier described. So in the sectorial indexes, all the, whether it is sectorial or single commodity or this one, all these are excess return index, which means that it will consider both the price return as well as it will take the roll returns as well. So it is by taking both the things, it essentially means that somebody can be able to replicate this index very conveniently. Unlike traditional contracts or traditional products, the replication will be challenging because of the tracking error, but this being a excess return index and built on the futures, underlying futures contract, it's very easy or convenient for market participants to just replicate this index with a very least tracking error. So the sector, coming to single commodity indices, we have already come out with gold, silver, and crude oil, and soon we will be coming out with single commodity indices of other base metals as well. And the sectorial indices are built over this single commodity indices. Take in case of the bullion index, which is built over the gold as well as the silver, and this is built on the most liquid, our flagship products like the gold 1 kg and silver 30 kg products. So one of the advantage of building on the most liquid and the front month is that somebody can able to replicate the index, either participating in the index futures or by participating in the underlying futures as well. So the metals, we got the permission for both the thing, bullion as well as the metal indices, but as of on 24th August, we have come out with the futures contract on the bullion index futures, which we call it as BullDex in short. And shortly, we'll also be coming out with metal index futures that will altogether will throw another dimension to this market, because these are sectorial and represent a different sectors of Indian markets. Like the metal, essentially this is covers all the 5 base metals like aluminum, nickel, zinc, lead, and the copper. So which essentially reflect the performance of the metal manufacturing sector. So the composite, it is a combination of all, but at present we are just wanted to go ahead with these two. And by coming out with these indices, I can see that this will act as a ready benchmark, because it is a real-time indices, and somebody can, the markets can really can able to see that what is happening in each of the sector, because price is one important essential element that reflects what's happening in that particular sector, given sector. And first the benchmarking, because we have started this indices in last December, and the indexes not only act as a benchmarking, but it is essentially contribute to in a great extent for the market, because many people, they can able to come out with their passive strategy, and they can able to benchmark themselves with the indices that are displayed to the widely disseminated to the market. Another aspect to it is by making it an excess return index, it is very convenient for trading as well. So we could see that it's not only the exchange. In fact, many stakeholders can soon come out with different variants of the products, like index ETFs or the basket trading or some other thing. So it throws away the many opportunities for the stakeholders and people. They can build up various associated products on this one, which can be linked to this index. To start with, the exchange itself has come out with the index futures. SEBI has given us the permission for both the bullion and metal indices, and we have already started with the bullion index, which has received an overwhelming response, I can say. And we could see that, like Mr. Reddy said, it's like we could see a wide number of, that means wide participants is entering into this market, and they could able to take their positions accordingly. And this is another contract which is compared to the underlying product is relatively a medium-sized product, which is about 8 lakh worth of contract, and the metal is, again, it is going to be around 5 to 6 lakhs worth of contract. So that way it is like it enables the different category of participants, whether including from retail to the institutional participants, can able to participate in this contract very conveniently. Secondly, this product being built on highly liquid contracts like gold, silver, and other things, it throw open 2 immediate opportunities. One is arbitraging between the index and the underlying constituents. So today we don't have the cross margin benefit. That doesn't mean that we can't come out with this one. People really can look for the opportunity, and they can see that whatever is the available opportunities are available in this one by using this particular strategy. Similarly, by these being built on the liquid contracts, and also by capturing the roll returns, one can able to mirror the performance of the index. That means just by taking a position in the underlying contracts, some can just exactly, he can replicate what kind of returns he is getting on the index, that he can get the returns on that one. That means the product index, we could able to trade independently on an index futures, as well as you can replicate the performance of an index by participating in the underlying index, and in total you can cross, that means you can arbitrage between across the product segments. That is the way you can look at these products. So like I said, we could see a very decent, not overwhelming response, tight ask and bid spread, and you could see market depth, good market depth, and the open interest is increasing on a day-to-day basis. That's all are encouraging and very welcome. Another important aspect is like today we have converted most of our products into compulsory delivery contracts, which essentially means that it can cater to the value chain participants as well as other category of traders and the other kind of participants. But this again, it is like gives us another different product, like because it is a cash settled product. So now it is coming in the midst of a time when we have all compulsory delivery contracts. Last but not the least, I can say that this is a really a good product for portfolio diversification, because the commodities are a different asset class as compared to the asset classes like the currency or whether it is equity markets. Just having a look at it, this clearly shows that this market is very cyclical in nature. And more interestingly, even within the commodities, the cycles have to be has been different. Like for example, the metal index performance have been always different from the bullion index. So this really can say that because of within the commodities, because of different cyclical in nature, they have a very low correlation, or we can say that it is a negative correlation in some of the times between the different asset class or within the commodity segments. To come out with one the example, the classical comparison between the index, generally it is the comparison between the gold and a dollar, which are inversely related. But here, bullion index happens to be, in fact, a representative of both a gold and the silver. Both are happens to be a having a safe haven status, and this definitely would have negative correlation with the dollar that we could see in the pictorial represent, like the way we have plotted. It is between the bullion index versus the US dollar index futures. And you can clearly see is that there is a lot of divergence in between, and you can see that there is a clearly a negative relationship that prevailed over a 5 years of period. Like it is the correlation on a daily return happens to be around minus negative 29%, which really says that it is like this asset class is altogether a different asset class, and it throws away a different opportunities. A similar example with a different asset class, like this is the one I have plotted between S&P 500 futures versus the bullion index. And again, you can see a different repeat, wherein again you can see a negative correlation between these two. For the period of 5 years, when we plotted on the returns, we got a negative return of 8.1%. That really says that these two are different asset classes, and having a different or low correlation or a negative correlation, it throws another opportunity that we call it as the benefits of portfolio diversification, wherein it is like if you look at the risk adjusted returns, when you adjust the returns, because it is like because having a negative correlation or the a divergent performance between these two asset classes, naturally the risk is going to get to some extent is going to get reduced, whereas you can able to manage your returns better. So this, by having a different class, this really will give us an opportunity for optimization of your portfolio. A similar example, and we have drawn between our Bulldex and the Nifty, which represents our Indian markets, equity market. Here again, we could able to see a very low correlation. In fact, again, we could see a negative correlation between these two things. like bullion versus the precious metals versus the equity market. So again, the underlying summary is saying, again, it is like this can be used for portfolio diversification because of its negative or very low correlation. So it's a very just a plotted just to show that statistically how it can be really won by uh, taking a position across the Nifty and or a bull dex shows that how one can be able to manage his risk better as while he's looking at his returns. Uh, so apart from the returns, so far whatever we have spoken about the portfolio diversification and other, this speaks about different the ratios people really look at. Gold silver ratio, which is very popular worldwide, and you by having a bull dex, in fact it is like we are trying to bring it together, wherein the gold silver ratio are in fact we are pitching them opposite to each other. That way it is like a convergence and divergence within the bull dex can throw that how this is representing in terms of gold silver ratio. That means people can look at the instrument while they are looking for strategies like the gold silver ratio and other strategies. Like I said earlier, it is like it interesting to know that it's like apart from the two that means different asset classes like currency and the equity and the commodities, when we plot even within the segments like the precious metal versus uh, the metal, so you can see that there is a very low correlation, and then we can see that a lot of divergence, and in between we can see that the convergence happening. It is because of their different fundamentals acting upon each other. So this is very interesting to know that, and when we come out with this metal index, it will really would throw more opportunities and strategies for the market participants. This is more about arbitraging, which I think most of our other panelists would be covering. So I'll move on to my last one, which speaks about what kind of market potential the product is having. So I can see that if you look at our Indian market, and even the global markets are more like alike, the products, the index products are predominantly dominating the market with a huge market share. So when we look at what kind of market potential these kind of products will have, because while you will have index trading getting traded, there will be multiple products that is going to get complement this index product and the underlying itself. And here you have, apart from the underlying index, we also have underlying the commodity futures contracts. So we see that the great potential and the great scope for this kind of products going forward, and we look forward for this one to show the path for the commodities derivatives market in the way forward. Thank you very much. I now leave it to Mr. Rashid. Thank you.
Thank you, Praveen, for your sharing your presentation. If you could kindly stop sharing. And now I would like to introduce you all to Ms. Fiona Bowl. Fiona is Head of Commodities and Real Assets at S&P Dow Jones Indices. She is responsible for the product management of the commodities, real asset, and housing price indices, including the S&P GSCI, Dow Jones Commodity Index, DJCI, etc. Earlier, she was Director and Portfolio Manager at Fulcrum Asset Management, where she gained a wealth of experience in proprietary research and specialist knowledge of energy, agriculture, soft and livestock commodity markets. She's also worked as an Associate Director of Commodities at Hermes Investment Management, Director of Commodity Research at Argonaut Capital Management, Vice President and Director of Investments at Harvard Strategic Commodities, and Executive Director of Food and Agribusiness Research at Rabobank International. I would now request Fiona to share her views with you.
Thank you very much for having me, Rishi. It's great to be with you virtually from London this morning. I would hope that sometime soon I will be able to visit with you in India. I haven't been to India for about 15 years, so it would be great to be back. Following on from Praveen's presentation, I'm going to go through commodity indexing from our perspective at S&P Dow Jones Indices, and actually expand on some of the things that he spoke about with regard to how commodity indices can be used by investors. A quick overview. I firstly want to just give you a quick review of what's happened in the commodity markets in the first 8 months of this year. It's certainly been a very busy start to the year. I want to look at the role that indices play in the commodity market and their relationship to the broader market. I then want to talk to you a little about the different types of commodity indices, and then, as I said, following on a bit from some of the stuff that Praveen just told us about the use of commodity indices by investors, and give you some examples. So what's happened in commodity markets so far this year? I mean, I think to say that the first 8 months of this year have been interesting for commodities would be a bit of an understatement, and I guess you could probably say that for all asset types. You know, the government mandated lockdowns in response to the pandemic have played a huge part in the commodity performance, certainly in the first part of this year. But diving deeper, there have also been some idiosyncratic stories that have been at play across different sectors, creating an environment where the performance was very distinctive across all different commodities, as you can see in the chart that I'm showing you now. You know, iron ore has been the biggest outperformer, benefiting from sort of the ongoing multi-year trends in demand from China, and on the flip side, some ongoing supply constraints due to mine closures. In terms of the precious metals, what we've seen is lower real rates, a weaker dollar, and widespread fiscal and monetary stimulus have really boosted demand for the precious metals, particularly gold, which most of you will know is considered a hedge against inflation and currency debasement. I'm going to talk a little bit more about that as well. The industrial metals have probably held up surprisingly well in light of the major hit that we've seen globally to economic activity, but I think it's worth remembering that they'd already suffered through some years of pretty bad performance. The grains and the soft markets continue to face issues with oversupply, while the livestock market has experienced a particularly bad year with the ongoing US-China trade war, the COVID outbreak, obviously, and some closures of some plants in the US. But the biggest underperformer, unsurprisingly, has come from energy, which is highly sensitive to economic activity. The S&P GSCI Energy Sector Index is down around 50% year to date. And the broad S&P GSCI, which is our headline commodity index, is very energy heavy. It has about 50% energy, its components are about 50% energy. So you can see it's also had a pretty big struggle so far this year. So let's look at where commodities and commodity indices fit into the broader ecosystem that is the global financial markets. I think it's first worth pointing out maybe the obvious, which is that commodities really are unique assets and they interact in a very unique fashion in the global financial market. On one hand, they're widely used physical assets or physical inputs to the global economy. But on the other hand, they're also investable assets, either in the form of commodity futures or financial products based on commodity indices. This makes them quite different in the way that they might interact or they might be valued and they might behave than traditional equity or even fixed income type instruments. And I think it's valuable to understand these transmission mechanisms and understanding how information price discovery works between these different mechanisms, and also to talk more about what I've called the financialization of the commodity markets. So before we dive into indexing, let's take a look at the financialization of commodity markets. And I've used iron ore as an example here because I think it's one of the great and more recent examples of how a market has changed and how new investor participation has adjusted the market and what that's meant. I think, you know, by commodity standards, the ascent of iron ore to the ranks of a global commodity that regularly graces the front pages of the financial press has been really swift. You know, it's probably taken only about 10 years for what was traditionally a very opaque market characterized by annual price negotiations to develop into a global market with two highly functioning futures markets. One being in China and the second one being the SGX in Singapore. And as you can see, you know, since the SGX launched their futures contracts, you've really seen the development of investor and non-physical player interest in the market. You know, more than 50% of the open interest in the SGX iron ore futures contracts today comes from either financial institutions or asset managers. And in commodity markets today, the role of these financial participants is to provide liquidity and to act as a mechanism to warehouse risk. The non-financial market participants the financial market participants can also improve the price discovery process in a market, can aid with transparency, and can act as an information and risk transmission mechanism between the markets. So we've had a quick look at how the financialization of commodity markets has worked and why it's important and why there's a value in having financial players in these markets. So I want to move now and actually look at indexing and briefly provide you an idea of the type of commodity indices that are available. You know, Praveen's been through some of the ones that are available in his business, and I wanted to just give you a brief idea of the type of other indices that are available. What I've got on the screen here are a list of the S&P Dow Jones family of commodity indices. And really what we start with is what I sort of call a headline or a broad market exposure index. And for S&P, that's the S&P GSCI, which is a production weighted index that has 24 individual commodity components. And you can think of it as the equivalent of the S&P 500, but for commodities. And then as you go down, you can also break out the broad-based index into more distinct individual commodities or individual sectors. So we have a gold or a precious metals or an industrial metals index. We also have indices that allow us to change the weighting structure. So instead of weighting on the basis of production, we could weight the components of a commodity index based on some level of risk, so some type of risk parity. We could equal weight. We could weight on the basis of market turnover or any combination of those things. And we have a large number of indices that fall into that category. We also have indices that have certain components capped, and whether that be for UCITS, which is an EU regulation, or whether that be just because an investor wants to cap the energy component of their commodity exposure, or whether they want to have an index that doesn't include a certain group of commodities. So maybe they want to exclude agriculture from their commodity index. We also then offer products or indices that are region specific. So we have a series of indices that are based on Brazilian commodity markets. We have a world commodity index that looks at the major commodities that trade outside of North America. And then we also have the ability to combine commodity with equity indices. So for example, we have a gold index that is a combination of both gold equities and gold futures. And similarly, we have products that are like that in the energy and the natural resources space. And finally, just like we've seen in equity markets, there's been significant and growing interest in factor investing in commodities. And so we can offer commodity factor indices, whether they be related to volatility, momentum, carry, which is a very popular strategy in commodities given that they're based largely on futures markets. So all of the type of strategies and factor indices that are available in equity markets in almost all cases can also be available for commodity investors. Why is making commodity index investing solutions available to investors important to us? And this is going to follow up quite nicely, I think. I'm not going to say anything too different to some of the stuff that Praveen previously spoke about. Commodities really do offer a wide variety of investment opportunities, but it can be challenging for some investors to get access to these return streams. And this is where we think that commodity indices can play a really important role, because it makes accessing those return streams easier and more cost competitive in a lot of cases. But why should investors care about commodities? I think, the two most common reasons given is that they, in some cases, can offer some form of inflation protection, and that they can also be a form of diversification in a portfolio. They're traditionally the two reasons that most people would give you for why you should consider having a small allocation to commodities in your portfolio. But I also think it's important to highlight some of the alternative investment uses for commodities, including using them as building blocks to express specific investment themes, as tactical trading tools, and as accessible market proxies in some cases, and even as a component of a broader multi-asset risk premia solution. I'm going to talk briefly about some of these investment opportunities. The first is inflation, and again, it's often the one that is highlighted most quickly by people when you ask them why would you consider an allocation to commodities. In the table here, I've used our headline S&P GSCI commodity index as a proxy for the broad commodity market. And as you can see, during periods of deflation or low or muted inflation, commodities don't tend to perform very well. And these figures go back 50 years. It's not once you get to a level of inflation above around 2% that you start to see the benefit of holding in commodity assets. And particularly during periods of quite significant inflation, you do see a very attractive return from commodities. Now, it is important to note that during periods of very high inflation, other asset classes sometimes can do well, but most often will do quite poorly. I think the low inflation environment over the last decade has probably really penalised inflation-sensitive assets. We know that inflation is notoriously difficult to forecast, and that what we often see are unexpected inflation shocks. But I do think, given the environment that we're in now, it is worthwhile revisiting the idea of inflation protection. What we know for sure is that commodities are inflation sensitive. In this chart, I compare the historical monthly year-on-year percentage change in US inflation against the S&P GSCI, and calculate an inflation beta measure for commodities. Now, inflation beta is a measure of the responsiveness of an asset's return to observed levels of inflation. And certainly history would suggest that there is some positive relationship between the level of inflation and returns from a broad basket of commodities. Unfortunately, that relationship is contemporaneous, which can sometimes make it difficult to capture unless that exposure is held consistently or continuously. And we know that, again, if we use the last decade as an example, holding commodities continuously in a portfolio has been somewhat of a drag on performance. But as the global economy recovers from the pandemic, inflation has certainly returned to the vocabulary of lots of investors that I speak to, especially given the sheer volume of monetary and fiscal stimulus that almost all governments have pumped into the global economy. And so I do think that conditions are, for the first time in well over a decade, suggesting that we may be in for a bout of inflation. The second reason to hold commodities is that's often touted is diversification. Diversification is often considered the only real free lunch when you're in the investing game. The matrix on the screen illustrates the long-term correlation between the S&P GSCI and other S&P Dow Jones indices representing equities, fixed income, real assets, and gold. As you can see, commodities do tend to have low correlations to traditional asset classes, and they can potentially offer investors valuable diversification benefits. We know that combining low or negatively correlated asset classes to a portfolio has the potential to reduce the overall portfolio volatility level without sacrificing returns, and sometimes even increasing risk-adjusted returns. What I've done here is looked at how adding commodities to a portfolio changes the risk-return profile. The slide shows the relative performance of a portfolio with commodities and a portfolio without. So without means just the traditional 60 equity, 40 bond portfolio. The first thing to note is that volatility is almost always dampened when commodities are added. Only from 2009 to 14 did adding commodities increase the volatility of the portfolio. Over the rest of the time period going back to the 70s, volatility was lower. And there are typically multi-year periods of outperformance and underperformance between these two portfolios. During the late 80s and early 90s, and then again in the early 2000s, the portfolio with commodities outperformed while offering significant reduction in volatility. And I would note that these three periods followed a decade of commodity performance similar to what we've seen in the last 10 years, which may suggest, along with the concept of potential inflation, that commodities may come back to the fore in terms of being a valuable addition to a portfolio. So while diversification and inflation protection arguments have been long touted by investors, there are additional investment opportunities presented by broad commodity indices, by single commodities, and by absolute return commodity strategies. Increasingly, I think there are opportunities for investors to utilize commodities in their portfolio as building blocks to express specific views of a particular market, a particular event, or a particular risk factor. Single commodities, whether we're talking about gold or oil or iron ore, can be useful to investors looking to express investment themes that are dependent on unique geopolitical, demographic, structural, climatic, and increasingly health and disease factors. What I've looked at here in this chart is a measure of two measures of volatility, looking at potentially the use of a commodity as a market proxy or as a specific risk factor. And what I wanted to do is just highlight to you just how unusual the move in crude oil prices we saw earlier in the year really was. Volatility is often referred to as a gauge of fear in the financial markets. What this chart shows is the volatility in the US equity market and in crude oil since the beginning of the great financial crisis in 2008. The equity volatility is in the light blue, and you can see it was much more pronounced than crude oil volatility 12 years ago. So during the great financial crisis, the impact was clearly more prevalent in the equity markets. They took a much more powerful hit. But what you can see happened this year was that crude oil volatility exploded much higher in April than equity volatility had in the prior month. I guess one could argue that the shutdown of the global economy had a much more devastating effect on commodities than equities, and maybe that the opposite was true during the financial crisis. We can also see that, interestingly, both the equity volatility and the crude oil volatility went up and down almost as quickly. And often what you see is that volatility will spike very quickly, but then take some period of time to decline. That's not what we saw this time. Although I do note that just in the last few days, we have seen the equity volatility indices tick up slightly. I think the bottom line here is that commodities can often be utilized as an alternative or a purer instrument to express a specific idea or risk factor. In the case of the economic impact of the pandemic, I think oil has proved to be one of the best proxies for market sentiment and one of the best proxies for the real economic impact of this devastating virus. I think another really important characteristic of commodity returns is that they exhibit what we refer to as positive asymmetry, which is a highly prized feature of investment instruments. Commodity prices have a tendency to rise quickly and in such a magnitude that investors sometimes don't have the opportunity to do what they call, when they say, chase the rally. So if we look at using commodities to express specific events, and here I'm going to also talk about the impact of the pandemic, then there's few better examples than the gold market. The chart here shows gold, the S&P GSCI Gold Total Return Index since the late 70s. You can see that the index hit a new all-time high in US dollar terms on the 6th of August this year, eclipsing the previous high from the summer of 2011. The underlying gold futures markets also broke to new highs in US dollars, but also in other currencies. I think gold's unprecedented rise this year, although we did see that uptick in gold prices really start last year, is driven to a great extent by the bearish sentiment surrounding the value of the US dollar. Lower real rates, widespread fiscal and monetary stimulus measures have definitely boosted demand for bullion, which is seen as a hedge against inflation and currency debasement. With many government bonds paying investors a negative return, or at the very least a very low return, the fact that gold is a financial asset that offers no income is becoming increasingly irrelevant to an investor's decision-making process. The weaker US dollar against a range of currencies is certainly supporting gold prices. The broad S&P US dollar futures index fell to a 2-year low at the end of July this year. And I think in the eyes of some investors, gold is likely replacing the US dollar as an ultimate safe haven currency. You know, this break lower in the dollar was certainly a positive catalyst for gold to make a new high. And historically, there have been periods in history where the correlation between gold and the US dollar was very negative. And it would appear that the environment is right for that type of relationship to be maintained at the moment. What this illustrates, again, in terms of understanding and using commodities in a portfolio, is the concept of using them as a tactical investment tool. So the concept of tactical investing is related to the idea of using, say, an individual commodity as a building block, you know, as I've discussed. And a tactical allocation could be based on the commodity fundamentals themselves, macroeconomic data, price trends, or in this case, you know, a specific event. And gold is an excellent example of this. That brings my presentation to an end. Just to recap, we've spoke about the wild ride that commodities have experienced so far this year. We've specifically addressed the value of commodity investing. I've also highlighted the different types of indices and provided you with a few examples of how commodity indices can be used in an investor's portfolio. This last slide here just highlights some of the relevant content that S&P Dow Jones Indices has produced on commodities in the last couple of months. I'd encourage you to please visit our website and to access this content and find out more about our commodity indices. All of this content is free to access, and we would love you to do that. So with that, I will pass back to Rishi. Thank you very much.
Thank you, Fiona, for sharing your insights into the commodity markets globally. Now I would like to request Mr. Anil Ghelani to share his thoughts. Anil is Head of Passive Investments and Products at DSP Investment Managers. Earlier, he served as the Business Head and CIO at DSP Pension Fund Managers. Prior to joining DSP, he's worked with ILFS Investment Asset Management Company and SR Barclay, which is a member firm of Ernst & Young. He is a volunteer with the CFA Society and serves as the Vice Chairman on the board of the CFA Society. He's also a member of the Committee of ETFs and Index Funds at the AMFI Association of Mutual Funds in India. Over to you, Anil. Please share your thoughts with us on indices. Thank you.
Unmuted. Yes, hi, good evening. Thank you very much, Rishi, for the very kind introduction. Just in a second, I'm trying to ensure my screen is getting shared. Yeah. Just to confirm, I mean, I'm audible properly. Actually, my line was muted by the host, so now I just want to make sure I'm audible and you can hear me and see my screen, right?
Yes, Anil, please go ahead. You're visible and audible and with the presentation.
Okay, sure, great, all right. So I think it was a very engaging discussion. Thank you very much, Fiona, for setting the context and giving the backdrop of two things. One is about how global macro trends impact commodities, and the second aspect is the way in which commodities can be, or commodity-related instruments can be used. What I'm going to do over the next couple of minutes is that I will try to talk about a little bit of different aspect in terms of how Indian investors can use commodities in their portfolios as an overall asset allocation. One or two slides I have kept as a base for my discussion, but otherwise I will try to keep it as open and free flowing as possible. To start with, I would like to reiterate the point which earlier was discussed by Debajyoti, that this discussion is being done, I mean, in my personal capacity and not necessarily reflecting the views of my employer organization, DSP Investment Managers. In very brief way, I would like to highlight this one very interesting chart and discuss to some extent what already Fiona outlined, that today where we stand in terms of the global macro picture and how in the past we have seen certain favorable fiscal and monetary stimulus impacting metal prices in a positive way. So if you look at the past 5 economic crises, what we have seen that in 4 out of those 5 global recessions, metal prices have picked up in a good way. In some way, it's quite logical, and Fiona explained very well in some of the charts that whenever there is a large amount of monetary or fiscal stimulus, at some point of time, it does give a boost to metal prices as well. If you look at the current situation, friends, where from the starting of the calendar year 2020, we have seen a sort of unprecedented crisis which has impacted many parts of the not just financial markets but of the real economy and the real world as well. To respond to that, governments as well as central banks have done a large level of fiscal as well as monetary stimulus. So one can expect that we are in a kind of a favorable stance as regards fiscal and monetary stimulus is concerned for impacting commodities. Connected to that, if we see inflation from an overall perspective, it's very important to highlight that here we are very much in the situation where a lot of money has got printed, a lot of stimulus has been made, and one can expect that on the basis of that we will see inflation coming back. We have also seen in the US markets that the Federal Reserve has certain inflation targets, and till the time those targets are comfortably breached, they will not really have any concern in terms of enhancing the money supply. Hence, we feel that inflation definitely will be something which will come back in the near future. So if we take it as the overall context and we try to connect the dots, we're looking at top-down approach of growth and inflation, I would just like to highlight and give a perspective of how the current situation is. See, today, world economy, we have looked at the past quarter's data. Different parts of the world have shown different levels of decline in the GDP. Structurally, for the entire year, the IMF has predicted about 4.9% degrowth in the global GDP, and different countries will fall somewhere around that. Now, if we see that now, that means the growth is in a kind of a declining phase, and inflation, if we feel, is in a kind of a increasing phase. So if we draw a matrix and we see which type of a situation we are in, it appears that we are in a sort of a stagflation type of a environment where we are evidencing lower growth and higher inflation. So typically speaking, whenever we see a higher inflation type of a scenario, we tend to see that, you know, the currency starts to see some kind of a decline in their value. And on this type of situations and these scenarios, one can expect more focus on real assets or commodities. It could be a combination of commodities, like, you know, maybe gold to start with immediately. It could be crude oil, it could be other base metals, etc. And this type of exposure allocation helps to mitigate your risk against inflation. So very clear. I mean, we are all on the same page. Yes, wonderful. So now the next question is that, ठीक है साहब, ये सब आपने बोल दिया. Now I am an investor sitting in India. I mean, looking at all this global macro, first class, boss, you've shown a nice chart. You know how in the past, from past 5 global recessions, current situation, okay, fine, everybody's grappling with declining growth. So what is it in for me? How do I invest my money? What should I do? So as an Indian investor, yes, definitely one should try to have an allocation into commodities. In the presentation by Praveen also, he articulated much more in detail about how the correlation between commodities and the other asset classes work, and how there is a very low correlation. So I won't go into specific details or numbers, but just because it was also fresh in mind about the ICOMDEX index, which got launched under MCX just about a week or 10 days back. So I picked up one of the broader correlation numbers of the ICOMDEX with the Nifty 50 and the treasury bills. Like, so, just trying to highlight that equities and fixed income returns are very low, are having a very low correlation as compared to the commodities. So from an Indian investor's perspective, one should look to allocate money as a kind of hedge against any kind of event risk, as a kind of hedge against inflation, like we spoke about. One should also definitely have it as a portfolio diversification, as a kind of a ongoing allocation. And fourth point, one should also look to invest into this asset class from the perspective of specific returns. So like as a tactical allocation, suppose there is a vision or there is a view that right now maybe it's a good time to allocate from only pure returns perspective. Maybe after 3-6 months, one can look to reduce that allocation also and come back to original diversification level exposure. So that type of a investment option also should be definitely considered by the investors. So all these 4 points, not just for portfolio diversification, static payment, take 5 to 7%, 10%, whatever your financial advisor suggests, and keep it as a diversification. Yes, certainly one should do that. Use it for hedge, for inflation, or for certain event-based hedge. Certainly that is also crucial. In addition, one fourth aspect which can be definitely considered is tactical allocation. I'll give example. Let's say about 8 to 12 months back, if one could try to foresee, of course, not exact situation that we are in currently and the spread of the virus, but if one could try to see that from October, November onwards, we were seeing the Federal Reserve suddenly enhancing the size of the balance sheet. From October onwards, they started a bond purchase program, approximately 80 billion per month kind of a situation. So by December, in the 3 months itself, roughly close to about, I mean, I don't remember exact numbers, but a good level of liquidity was getting pumped into the system. Connecting that with some other parameters, if one could figure out some investment view that maybe in next 6 months, I should try to invest into commodities as a tactical allocation for gaining higher returns. One could do it through some kind of a commodity derivative on the MCX, or some kind of a individual line item, like let's say gold futures or silver futures or base metal, or like the current combination like gold and silver type of a bullion index. Of course, 6 months back, 8 months back, it was not available, but just I'm giving as a perspective that how it can be used in these 4 manners. Now, if we look at how exactly can the investor access this type of commodity into their portfolio? Fine. One way is that investor is very well aware of the way in which commodity markets operates, is like kind of an active investor on the commodity exchanges like the MCX. Then he or she can very easily access that particular market and go into this particular bucket, which is at the bottom right hand side. Just buy through the commodity futures market through MCX or like relevant market access. If not, then there are various 6 other alternatives how an investor can access commodities in their portfolio, right? So I would like to just highlight and touch upon few of them in a very brief way in terms of how an investor can allocate money into commodities. One is, of course, plain vanilla, simple, old school methodology, buy physical commodity. Where today's world, one has the time also, and like, okay, I want to buy, might be possible for some bullion, let's say gold, to a certain extent silver, but quantity will be like large, where you will go running around to store it, etc. So like little bit not so easy, and that too if some other commodity, so you can just forget it to try and hold it in physical side. But yes, that is one alternative. Second alternative is to allocate through the exchange traded funds, the ETFs. So today, if you look at, there is a wide variety, close to about 12,000-13,000 crores of money invested through gold ETFs. Now in India currently, just gold ETF is available. So if one wants to own gold, yes, that ETF route is available. Just to put it into a little bit context, gold ETF is close to about 5% of the total ETF AUM in the Indian markets at this point of time. If we look at other aspect, then one can invest into AIFs, alternative investment funds, or PMS, portfolio management products, which can give exposure to commodities. I will go a little bit detail shortly. Or there could be certain structured products which can be available or offered, which have a linkage to any underlying commodity, etc. Or one could invest in certain mutual fund schemes which provide exposure to the commodities in small allocation. Like SEBI has been very open in terms of the whole evolution of enabling mutual funds and AIFs and PMS managers to invest into commodities through the futures, derivative contracts. and any kind of alternatives where investor can access is through this route as well, where let's say some kind of a multi-asset portfolio is there, which can invest up to 30% into commodities. So those kind of mutual fund schemes, can be accessed by the investor. The next item is about the commodity futures, which I already articulated, that one can buy the derivative contracts through MCX. Or little bit related to that is commodity stocks, either buy direct stocks or mutual funds which invest into commodity related stocks. So broadly, these are the kind of avenues where an investor can invest. And globally, some of these market segments are very large. So like, for example, the size of the futures commodity market, of course, I mean, it was more articulated, and like MCX will have much more granular data, but broadly I would think close to 30-40 times the size of actual physical commodity typically is how the futures commodity, I mean the derivatives on the commodity markets operate. Likewise, the total on the funds side, like close to about $550 billion worth of assets are invested across the ETFs and commodity related products, both whether active side or passive side. Products, this is just 550 billion is the number of the US and the UK markets. Other markets slightly developing shortly. And in the utilization of commodity indices, so structurally, like there are many indices available. One basic utility of the index would be to use it for a benchmarking purpose. No doubt, it's a great tool available for highlighting the way in which the trends are evolving, or for mutual funds or PMS managers, it can be used as a reference point or a reference benchmark index to see how their performance is operating, is doing vis-a-vis the particular benchmark. But other than just using as a reference index or as a benchmark, one can also use indices in actual investing in the portfolios, both whether it's a derivative on the commodity index or single individual derivatives. It can be very useful in actually holding in portfolios. So very quickly, I'll just highlight some of the areas where it is easily usable. One is, of course, in investing through the ETFs, where the ETF can invest into the derivatives in a certain percentage in addition to the underlying commodity. So here the view of the investor is like to participate in line with the movement of the commodity. So let's say, for example, gold ETF is there, and investor is entering with the intention of getting a risk and return equivalent to how the gold price movement is happening, but does not want to really have the difficulty of directly buying on the exchange, because then every month or periodically they will have to roll over the contracts. So instead of that, they will come into a ETF that, okay, now the ETF manager, the fund manager will be responsible. So he or she will do the rollover or own the physical commodities in conjunction with the derivative and give me exposure of the risk and return in line with that particular commodity. Other aspect is on AIFs or PMS products, where other than this type of directional view, one is of course based on certain technical views or fundamental views of the portfolio manager, where the investor will gain exposure to different commodities. It could also have certain specialized features where it is purely arbitrage driven. So it's market neutral, and it's only playing on the arbitrage. So it could be like just cash carry forward or calendar spreads, or different arbitrage strategies are available, but market neutral. So it does not go on the directional movement of the underlying commodity, but purely on the market neutral basis. And the third is like what I spoke earlier about, how in certain mutual funds one can own some allocation into commodities, whether it's like in the form of multi-assets portfolio or in the form of hybrid funds. That kind of allocation can be utilized for that. And as I was saying, as things move forward and investors become more and more aware and wanting to invest into commodities, further more evolution and development can happen in this type of space, like for example, now the index derivatives have started trading. So earlier, if you wanted to invest into some particular commodity, you had to buy individual contracts. Now there is a composite, like for example, there is an ICOM DEX composite index, which has a composition of 11 or 12, different commodities, including bullion, base metals, etc. So with buying only one single, of course, that is just, I'm saying, futuristic. So by buying that one particular index, you can gain exposure to a diversified basket. Or let's say what is I mentioned earlier, recently 8-10 days back, which has gone live, the ICOM DEX bullion index, where there are two underlying commodities, gold and silver, which are available. So gradually, as this market and the various indices evolve and trading enhances, liquidity enhances, there could possibly be products which are as similar to certain global market products, like Fiona highlighted. Like in her slide, I remember very optically, first section itself was a particular index which is very beautifully described, similar to, let's say, S&P 500, or in our context in India, let's say similar to Nifty 50. So while I'll just take one more minute and then I'm concluding that, let's say, for example, today, if there was an investor, okay, who is investing purely into, like, traditional investor FD, fixed deposit investment. So few years back, they enhanced further and say, let's start with buying a little bit equity also in your portfolio. So instead of just buying fixed income, fixed deposit, let's buy some equity as a component. And to start with, let's buy simple to understand Nifty 50 ETF, for example, diversified across the various sectors and easy, transparent kind of a allocation. So now similarly, when the first port of call for investors to start allocating to commodities will enhance, this type of product can be a very good starting point. That, okay, now you are investing into some fixed deposits, you are investing into some equity, like a diversified basket like Nifty 50. Let us start with, let's say, some allocation into a diversified basket of commodities as well. Don't look at one particular, let's say gold might be volatility is there right now, some view based, but this is a broader basket of multiple commodities. So this type of evolution with the index, with the products will start. So that kind of a development, I think, will be the next important part of the way in which derivatives and commodity derivatives on single commodities as well as on basket of commodities as a commodity index can be utilized. So with that, I would like to just conclude the discussion, but happy to later on take any questions or suggestions or any inputs. Thank you.
Thank you, Anil, for your insights. Sorry, I got logged off for a minute.
No problem.
Very, very insightful. Now we will open the session for questions and answers. So I would request all the participants, whoever wants to ask questions, to type their questions into the chat box, and we will take the questions from there. While we get questions, I'll start off with a few questions of my own. So first question for you, Fiona. What are your views on options trading in commodity indices? Any global references on this?
Thanks, Rishi. Yeah, we have seen actually most recently quite a bit of interest in incorporating options in commodity indices. One area that we're looking at is to embed zero put options in indices to avoid an index falling below zero. The other area that's quite well developed in the options space is sort of covered calls and strangles and straddle type strategies in using commodities. You know, the benefit you have often in incorporating commodities in volatility strategies is that, as we talked about, you know, their return stream is very uncorrelated to anything else. So if you're running a short volatility strategy that's multi-asset, including some of the bigger, more liquid commodity markets, it's proved to be quite attractive from a return and risk profile. So using things like natural gas, gold, crude oil, you know, where there's a well-developed options market. Gets a bit more difficult in some of the smaller commodity markets where the bid-offer spread in the options is just too wide to adequately sort of or efficiently incorporate the option in the strategy. But we do expect to see growing interest in the use of options strategies in a index wrapper.
Thanks, Fiona, for that. I'll ask the next question to Anil. Anil, can you provide some insights into commodity indices which are commonly used for tracking by the ETFs? And are they normally administered by a third party or by the ETF provider themselves? And do they have derivatives based on them? Anil, you are muted.
Yeah, I was, but I think the organizer is, yeah, now I think I could unmute it. Yeah, it is not allowing to unmute when manually. Okay,
sorry.
See, Rishi, from Indian market perspective, as I articulated, currently we have only one type of ETF on commodities, that is the gold. Now, gradually as the evolution will happen, there will be other indices on which ETFs will be running. So I believe that the kind of indices that recently MCX has created, you know, those could be excellent tools, indices which can be used. But currently we are not using that. I'll be very open, because we don't have those type of products available. And to the other point, whether the indices are managed and run by the fund manager themselves or by third party, very certainly in Indian context, it's run by only third party, because the fund house, let's say today, if a DSP was to launch any index or any ETF, we can't be the index provider. You know, it has to be, let's say, for example, you know, like your MCX like index, like a third party IOSCO compliant index provider, you know, who on whose index we can run our products. So most certainly regulation currently, the way in which it is, does not permit any fund house to run their own index and launch a ETF or index fund on that. It has to be a publicly available index run and maintained by a third party, like a official, I mean, somebody who is officiated by the regulator.
Okay, thanks for that, Anil. Fiona, one last question for you. We're not getting any questions from the audience as yet. But is trading in commodity index derivatives prevalent in the OTC markets globally? And if so, how is it comparable to trading on the exchange?
I'm sorry, I missed the end of that. The OTC market versus what?
So is trading in commodity indices prevalent in the OTC markets globally? And if so, how is it comparable on the exchanges?
Certainly, most of the business is OTC. So, you know, let's use a US pension fund as an example. They would most often get access to commodities using a swap with a bank counterparty that would be based on some index or some specific bank product. The exchange market is growing, We have listed futures on some commodity indices, as is the ETF market, and particularly in Asia, we've seen enormous growth in single commodity ETFs across a lot of the bigger Asian markets. But still today, the bulk of the business is done OTC.
Thanks for that, Fiona. And I'll hand it back to my colleague Devojyoti to take this forward. We are, I think, running short of time to get into the next panel discussion. So over to you, Devojyoti.
Thanks, Rishi, and thanks to all the speakers. Now we are all set for the second session, which is a panel discussion, as I said, on the theme Index as an emerging product for the bullion industry. And we have a very distinguished set of panelists with us today. First, we have Mr. P.R. Somasundram, Managing Director, India World Gold Council. We also have Mr. Dilip Narayanan, Head Bullion and Treasury, Malabar Group of Companies. And the session will be moderated by Mr. Shivanshu Mehta, Head Bullion MCX. Before we start the session, a reminder once again that the questions will be asked. The questions for this panel, the panel discussion, will be taken up only towards the end. And again, I request all of you to ask the questions in the chat box. Type out your questions in the chat box, and they will be taken up towards the end. And please mention who would you want the question to be answered by. Over to you, Shivanshu, and please introduce the panelists and take it forward.
Thanks, Debo, for the opportunity. And it is indeed my privilege to introduce these two stalwarts and industry captains before the audience. I have with me Mr. Somasundaram, PR, or Som as we like to call him, as the entire industry calls him. He is Managing Director India of the World Gold Council since January 2013. Som is responsible for leading the World Gold Council's activities across the Indian gold market. He has over 27 years of experience across diverse industries, including FMCG as well as banking sectors. And prior to the WGC, he was the CEO of a regional private bank. And before that, with the Standard Chartered Bank in India for over 8 years in various senior roles as a member of the management committee. Previous to this, Som has also 13 years of experience with the Hindustan Unilever Group in a variety of roles in financial management, logistics, and mergers and acquisitions. And of course, Som is a qualified chartered accountant. Welcome, Som. And I introduce to you now Mr. Dilip Narayanan. Mr. Dilip Narayanan is again an industry stalwart who has spent more than 23 years before this with the Scotia Bank as the marketing head for the bullion business in Scotia, as well as in various areas of the bank. And now he's heading the bullion and the risk management and the treasury operations at one of the leading brands of gold and diamond jewelry in India, which is one of the largest retail chains across the country as well, the Malabar Group of Companies. As a practitioner, Dilip brings with himself a tremendous experience in various types of hedging strategies and various types of physical strategies merged into the financial products. Welcome, Dilip.
Thank you.
So the way I wanted to structure this discussion is, we've had a tremendous action in this industry, in this sector of gold and silver since March to September. Probably these 6 months have seen so much what previous years have not seen. And so the first portion of this discussion will be about understanding the global trend amid this lockdown, The second portion would be dealing with, and of course, we'll juxtapose the index within that trend, right? The second portion will be to do with index as a vehicle for participation in this macroeconomic ever-changing world, as some of the speakers pointed out, a tactical way to invest. So as an investment vehicle. Third will be the index and what it brings to the table for the physical hedgers, in addition to what they do with futures and options. So starting with the first point, I just want to paraphrase before I leave it to Som for the international trends, and then come to Dilip for the domestic trends in jewelry and bullion. You see, we've seen prices first rally from 39,000 rupees in March to 56,000 rupees, and now at 52,000 for gold. We've seen silver rally from 35,000, the low of 35,000, to over 70,000, and about 66, 67,000 where it is now. We've seen silver give a tremendous cash and carry amid a very static physical market. So we've seen a changeover of hands from the physical to the to the financial intermediary in silver. Very interestingly poised. We've seen the ETFs go up globally during this lockdown, about 25% on average in gold and silver put together. Closer home, we've seen the sovereign gold bonds mop up 48 tons of gold. Out of that 48, 18 tons in just the previous 5 tranches, and out of that 18, 6.3 tons in the very recent tranche. We've seen Digi Gold go up in a huge way, and at MCX, of course, we've seen our futures and options volumes go up 68% over the previous year, which again was 91% over the previous year. We've seen volumes go up, we've seen prices go up, and the turnover today is around 19,000 crores. And the retail-oriented new products amid all this, which is our gold petal 1 gram contract, which was our unique offering to the market, a world record contract. It has seen tremendous growth in turnover and to about 60 crores a day in August, although it's a smaller contract, and 20,000 coins change hands. Similarly, silver 1 kg contract has seen 20 tons of silver via the 1 kg bar change hands in the previous 3 to 4 expiries. Amid all this is another product which is taking birth, which is the index, the Bulldex. So, which the speakers before me have highlighted to you, a cash settled product based on 2 parent futures. It has various advantages it brings to the table for portfolio and investment. Now, I want to first come to Som and ask you, what exactly have you seen change? How has gold and silver suddenly come back as an asset class amid this lockdown? What is the global trends that you're seeing? Som, over to you.
Thank you very much. I think the session has been very, very informative. So it's a question. If you really look at gold today has outperformed all the major asset classes in 2020 so far. Whether you take it as NASDAQ, US Treasury, US corporates, EM stocks, US cash, anything you take, it has outperformed it. Okay. Now, where has this been? When did this actually start? I don't think putting everything in as an outcome of COVID is right. It all started last July. See, even before COVID, there was a 180-degree change in the US Fed stance. When they were talking about rate increases, they suddenly came out and said, now we are going for a rate cut. Now that changed the scenario completely from July last year, and then the prices started moving up. So, and COVID only exacerbated this situation. So today, if you really look at it, of course, COVID, lots of people have spoken lots, safe haven, low interest rates. Low interest rate is one of the biggest drivers of this gold demand. So it's not, that's why I'm always convinced that even if the vaccine comes, yes, there may be a short-term volatility in terms of people probably moving in or getting a better sentiment, etc. It's not going to fundamentally change the things. The low interest rates, negative interest rates, that is what is driving this. Apart from that, of course, the safe haven demand has come in, and therefore, fundamentally, what changed in the market? If I were to say, there's a lot of money, there's a lot of liquidity, and money is today, it doesn't seem to have any cost. So the cost of holding gold has come down so much, and in many cases when it is negative, $15 trillion of sovereign debt is in the negative interest rates. So people will feel that it is much better to hold gold even if it doesn't give a coupon, because it's not negative, and that is also driving the gold price up. So it's a combination of interest rates, safe haven, a few of the events that have happened in terms of lockdowns and other stuff, and a fear that has crept into the world economy, the sentiments of people.
Point made there. So interestingly, since the liquidity as well as the negative yield and these two monetary easing, so these two environments actually augur very well for precious metals, and that's very interesting because our Bulldex or the bullion index is unique because it offers a sectoral play. It offers a sectoral play, or where you can partake by investments in gold as well as silver together in a certain ratio. So interestingly poised there. Yes. Coming to you, Dilip, now. So Som has sketched before us the fundamental reasons, which have played out, which are continuing to play out internationally. How has the experience been at your end? Is there a sort of a trend which you've seen emerge or change when it comes to jewelry or when it comes to looking at bullion? And what are the other, such important fundamentals that you've noticed?
Yeah, thank you, Shranshu, for inviting me here. And it's been a very interesting debate, discussion which has been happening. As I mentioned earlier in a couple of forums, I would like to repeat the same. Being a retailer, I've seen a wide range of changes which has been happening now from what it was pre-COVID. I would say the major change, what has happened is the buying pattern or the buying trend of the client has changed a lot. There is more of there is more of clients who walk in with a definite decision of buying the material, the metal, and not doing a window shopping. And secondly, what I have seen is that yes, as Mr. Som mentioned, this more than buying jewelry for the marriages and everything, then again the safe haven is also is core into their mind, and hence there is a lot of bullion purchase happening. There's been coins. I mean, we have very recently introduced 24 and 24 karat Malabar coins in all our stores, and then that's been it's been sold very well, and the response has been very good. As I mentioned earlier, also in a couple of forums, like the advance schemes have increased in the stores. I'm sure it's happening with the other chain retailers also. The advance schemes have increased based as the customers still feel the gold is bullish. So there has been a huge crowd for booking the advance schemes, and also the buying pattern has. When I mentioned the buying pattern has changed, it is more of like, for example, if the customer has booked the advances for a kilo of gold, we are seeing that the purchase is more than that. It is almost almost 500 grams more, or a half a kg more, or a kilo more of jewelry which they purchase now. And what we have felt is that yes, the wedding expenses, the other expenses have come down, and the client, the customer is putting on all those money again back in gold in purchasing more gold, as they feel that that would be a safe haven, because that's one commodity which could be liquidated at any point of time other than currency. So I find a very positive move from the clients during this season, when we have been like, there have been most of the times when the stores have been closed, and so they were almost 3-4 months. It's like there's been hardly 1.5 months where we were able to open our stores for the clients, but still we could see the business which happened last year during this month that has come back. And also there is one more interesting thing which is happening is, yes, the flow of scrap has increased. The old gold jewelry, people come for exchange majorly, and also for weddings, we find that the old gold has been exchanged a lot. My business is almost, I can see a good number of percentage of scrap coming in. So I mean, I'm able to manage with the scrap my ongoing business also. So that's one of the difference which I've seen during these seasons.
I see some very important takeaways there from what Dilip said, and I'll come to you, Som, with that. What he clearly is mentioning, that there is a decisive, consideration given to bullion as well by the retail walk-in clients, and hence jewelers like Malabar, and I'm sure even others are on their feet, coming out with a variety of products which are bar and coin type in nature. How are you see, and considering that India, also the wedding was one of the main areas where gold used to be used. So how do you see all this put together? In which direction is this going? And how has it been internationally?
Yes. See, if you really look at the global markets, all consumer markets have suffered. It's not India alone. In fact, we have seen this half-one performance of jewelry has been one of the lowest we have ever seen in our data series. So while prices have gone up, consumer demand has weakened. It's been made up partially by record ETF inflow, but clearly consumer markets are struggling with not just the increase in price, it's also the fact that their own incomes and anxieties are increased. In a normal situation, they will flock to gold when there is anxiety, but here there is no, I mean, probably the flow of money is also not there. So and as Dilip rightly said, people are also trying to recycle, so that trend you will see increasing. And we also believe at these prices, people will always want gold. I mean, that's never going to go out. So what they would try and do is, instead of buying a jewelry where the conversion charge could be higher, they would probably still like to get their hand on a piece of gold where a coin or a bar will have a lower conversion charge. So already I'm paying 55,000 plus GST. If I make only another 2,000 rupees, whatever, then I could get a coin, or 1,500. Whereas, if I had to buy a jewelry, I still have to lay out another 5,000 rupees. So that will certainly weigh in the mind of people. So it is very natural, and I do expect this trend to continue. People will probably flock to very, bars and coins. And at the same time, I don't expect once the market opens up, the top end of the jewelry to come down. In fact, I would think that there will be a surge in demand at the top end. Don't forget, it's the bottom, and where people will look at all this, these things. Top end people have saved money, lots of money. They haven't been able to spend much. Okay, so they read a lot more about the anxieties and things like that. So they may actually go in for the high-end jewelry.
All right. Thanks, Som, for those views. Now, coming to the second, so one thing is pretty clear that people have understood that gold and silver, they belong in the portfolio in one way or the other, whether it's a paper gold or it's a digi gold or it's bullion. And like you said, the top end jewelers will continue to see the top end jewelry demand as well as things unfold. So clearly, a vehicle of participation is required, whether it is an ETF, which is efficient vehicle in capturing the movements. So that is where, apart from futures and options and bonds, here now and ETFs, here now is available a product which is an index, which is cash settled. And there are times like from Fiona's presentation and from Anil's presentation, at points in which it makes sense to take part in this macroeconomic activity by way of taking an index position in a composite of a precious metal product. So I just wanted to share on the slide when it comes to this aspect very quickly. So if you see that the commodity prices relative to equities at various points in time. So this suggests that the commodity prices have never been more depressed relative to equities since the late 1990s. We are here in 2020 and it's at 0.145, right? So it makes sense for a retail investor to actually, take an index derivative position and be able to participate in a possible turnaround or a gap which has to be made up, and do it in a sectoral way in which he has gold as well as silver exposure taken together. Now, for example, the gold silver ratio itself, if you look at it, it has actually always been a lead indicator of economic expansion or contraction. When we saw in 2008, the peak of the gold silver ratio was 82, and then in 2011, when the recovery was about to start, it had become 31, which means silver, being an industrial metal, starts to give a move. So based on various such trends, and also another important thing, which is that a portfolio, if you can see the screen here, is it visible? Yeah. If you see the portfolio of stocks and bonds, when you enrich that with gold, not only does the risk, and this is from 1977 to 2016, not only does the risk come down, okay, the volatility comes down, the beta, and the total returns, and this is what even Fiona was mentioning, not only get risk-adjusted returns, not only get maintained and safeguarded, at times they even go up.
Yeah.
So having said that, this has an ideal mix, it is felt, for a portfolio-based approach. I wanted to take your views on this aspect. Som, and then Dilip.
Yeah. No, I think that was a very, we did a strategic case for gold in India. We released the report in April, and we have come to the same conclusion. In fact, our conclusion was that if you have, I don't have the presentation, so you don't have to say this. Allocation of 4 to 17% in any of our pension or provident funds. We took a select SBI, etc., increases in significant amounts the risk-adjusted returns, which exactly what you said, volatility is low, and overall absolute return is high, but risk-adjusted return is higher. So all of us essentially come to the same conclusion that a certain amount of gold in your portfolio is the most safest thing to do. Now, how much depends on the risk profile of your own portfolio. So we are not investment advising on this front, but clearly everybody has to look at a certain amount of gold in the portfolio. And I've even made a point in some forums. You see, today what is happening is our government wants to promote financial products. Okay, but if you really look at it, all portfolios, whether it be our insurance, whether it be a PMS, everything has actually in this COVID, particularly since March, we have seen all of them are giving negative returns, low returns, whatever it is. I'm just leaving it. I mean, all of us have seen volatility. Had they been allowed to hold gold more freely, now their own performance would have been better. My insurance would have looked much better. But today insurance funds are not investing in gold. Now what's therefore happening is, by restricting gold, we are making gold look better. Had gold been a part of the portfolio would have looked not as bad as gold. I mean, not as bad as compared with gold. So by restricting gold, we are making the financial product, which we want to sell more, look a lot worse, relative terms, I'm saying. So these are important things. So that is where the introduction of this futures by MCX, I think it's a very, very good good thing, because it makes it easy for people now to diversify. And of course, it comes with, you know, instead of saying I bought a gold, you are just saying now I bought a, you know, bullion index. You know, that's so when you're looking at equity index, I think a bit of portfolio management through bullion will happen. Now, it will always take time for people to get used to it, but I am very confident that this has come at the right time. And with all the talk about portfolio diversification that is now sinking in, this will be a very, very value adding product.
Thanks, Som. That's exactly very, very well paraphrased, you know, in terms of portfolio. And just a thought which comes to mind, I thought I'll add here, that since it's based on two parents which are actually Indian prices of gold and silver, not you know, they are taking into account the Indian market scenario, including domestic premium and their domestic benchmark parents, the silver 30 kg and the gold kilobar. So maybe at some stage, this actually helps in India becoming more of a price setter, directly or indirectly. As this index matures and there is more salience attached to this number, you know, today 16,000 something, what you see on the Bulldex. So slowly, people will probably start viewing it in that way.
Yes, yes.
Yes. So coming to you, Dilip, you know, while I understand that, you know, you're talking about hedging and Malabar, but considering that you have such a vast experience, how do you feel this aids or adds value to the investment or portfolio approach, including hedging against equity portfolio falls as well? Yeah.
Well, I would agree to what Mr. Som said, that this is one of the right time where you guys have introduced this index. And well, being a retailer, and our prominent hedging has been always gold, because we've not been a part of silver as of now. But in near future, when we think about you know, getting into trading, definitely this would be one of the instruments which we would definitely use, because as you also rightly mentioned, that might become a price benchmarker in near future. So yes, it's a very good move what you guys have done. And as far as a retailer who forget about Malabar, because Malabar predominantly is into gold and diamonds and not into silver, but there are retailers who have I've seen in a lot of tier 2, tier 3 cities where they have these silver also on equal quantities being sold. So for them, I'm sure that this index would really help to hedge themselves better. And definitely, yes, for a bullion trader, this would be one of the best instrument which they would have been looking for some time now, because they always have both the metals involved, like both gold and silver in that.
And Shivanshu, if I may just add to what Dilip said, this is also a sign of the market maturing. Yeah. In all these, you know, I would again, Dilip and both furiously agreeing with each other. This is a right time this product has come. and with a little bit of marketing support in a couple of years, I think this will become a part of the portfolios, because this is an index product. This is widely used by people. I mean, gold and silver. Everybody is keen to know what's happening to those prices, but they may not really want to even buy. And the other one, if I may add, you know, people are holding on to sovereign gold bond, and many times they, because of lack of liquidity, because there is no market maker, they may still feel that, look, maybe the price will come down, you know, in a few this thing. Now, this, if you have, you don't need to take any risk. If you have a certain amount of sovereign gold bond, you can just do another trade with the bullion index, depending on your price for 3 months or so. It's like you have already dealt with the sovereign gold bond and actually, you know, leveraged your understanding of the price. Now, these are all obviously investment managers will work with them, but I'm just saying this is also give me a greater flexibility if I'm holding a product like SGB, where the liquidity is not very high.
Yes, I think absolutely, you know, a very well made point, because the liquidity here, since day one, it was launched on the 24th recently, it has become fairly liquid because the participant base is high, and there is a direct linkage with the underlying futures, which are itself liquid, and it's a cash settled monthly product. So I think you made a very valid point that cross hedging, basically, you know, a sort of a hedging of gold and silver products across categories can take place, and this can actually become a part of portfolios going forward in a few years as a regular run-of-the-mill thought process, that yes, you need to have this, and you also can pick up an index, Bulldex. So I think points are very well made, Som and Dilip, and I think getting a thumbs up from two experts like this product should definitely see you know, excellence in the coming days, months, and years. And I'll just now throw up the floor for questions, please. Devojyoti, would you be able to see the questions, if any, from the audience?
Well,
Hi, yeah.
let me see.
You want to say something? Sorry.
So there is this question for Dilip actually. How do you see the overall sales of gold in FY21 versus FY20? Somebody has asked this question for Dilip.
Sorry, I couldn't hear you properly. Can you just repeat?
Somebody has asked, there's a question, how do you see the overall sales of gold in FY21 over FY20?
Well, definitely down by 50% or more than that. But as I mentioned, as things are progressing, as the months progress, and as how we open our showrooms in different cities, as we are our presence are in almost all the cities in India. We have almost 125 stores in India. So as and when the stores are opening, we are seeing business coming back. But if you compare the last financial year, definitely we are down by 50%. And I'm sure that is there with all retailers, or for that matter, any business.
Right. So there's another question on hedging. It's not asked to a particular person. I think Shivanshu, you can take it. The question is how to hedge gold against Bulldex. I believe the question is how do you use Bulldex to hedge in gold?
Yes. So essentially, we have an array of products which are used by hedgers depending on their business model. For example, an importer of gold would undertake offset hedging in the futures, and at the same time, options and index can be used to hedge that position and efficiently manage it in terms of the M2M. For example, if you short hedge via futures, you can buy a call at the same time and protect yourself on the downside and manage your M2M better and also be participative in the upside. Similarly, a bullion trader who would have both gold and silver, he will be able to use certain number of lots of bull decks along with the underlying futures to be able to create a perfect hedge in terms of value of gold and silver, which he's proposing to manage in terms of risk. And considering that this is a cash settled product, it makes it very convenient for hedgers as well.
Sure. So there's another question. I think this is a wish of the market, and I don't think we have it now. The question is, if I hedge bull decks with gold and silver, do I have any margin benefits? So this is a wish.
Yes, like you rightly said, I think it's a wish of the market that cross margin benefit in due course of time. Definitely, we should be hopeful always, because the portfolio margining benefit is something which people today enjoy across futures and options, and essentially the benefit of having liquidity in a given exchange across products is this only, that you get a portfolio based benefit in margins itself. For example, a portfolio based margin requirement in options and futures put together would probably be at 50% or thereabout of the individual margin requirements of those individual positions. So hopefully we should look forward to a favorable this one in time.
So I think we have time for only these many questions. We are running out of time, so we'll wind up for now. So with that, we come to the end of this wonderful webinar. Thank you all the distinguished speakers and the eminent panelists for your time, for your valuable time, and for sharing your perspectives on commodity index trading. Special thanks in absentia, because she has left now. She had to leave for a meeting. Special thanks to Ms. Fiona Ball from S&P Dow Jones Indices for sparing your time and joining us from a very different time zone altogether. Thanks to all the participants for joining. We are very delighted at the large participation at today's webinar and hope that you have enjoyed the deliberations. Tomorrow you would be getting a mail from MCX webinar, the same ID that you got the joining link. So my request to all the participants is to please send your comments, your valuable comments about the webinar, and we would love to hear about how you felt about this webinar. Lastly, I thank our colleagues at MCX and S&P Global Platts for their support in conducting today's webinar, and we are sure we will meet you all very soon in another webinar. Thank you all, and have a very good evening and a great day.
Thank you.